income matters, especially in retirement. So, common issue among retirees is having the majority of their retirement savings concentrated in a single tax bucket. Often, they're tax-deferred accounts. While this approach can be effective during working years, it may create challenges in retirement. Heavy reliance on one bucket may reduce flexibility, increase exposure to future tax rate changes, and force higher taxable income later in life. Okay, so there are basically three tax buckets you can draw from, and I'm not counting pensions or other things like that. So most retirement assets fall into one of three tax buckets: the tax deferred, tax-free, or taxable. Tax-deferred accounts, such as traditional IRAs and 401ks, generally provide upfront tax benefits, but create taxable income later. Tax-free accounts, such as Roth IRAs and Roth 401ks, are funded with after-tax dollars, basically dollars you've already paid taxes on, and can provide tax-free withdrawals if the rules are met. Taxable accounts, including brokerage and savings accounts, offer flexibility and may be subject to capital gains taxation. Understanding how these buckets work together is essential for creating a sustainable retirement income strategy that balances growth, income, and efficiency. Okay. Retirement does not eliminate taxes. Instead, it often introduces new tax considerations. Withdrawals from retirement accounts can affect income taxes, that's for sure. If they're traditional IRAs and 401ks, the taxation of Social Security benefits, and Medicare Part B and D premiums through IRMA surcharges. By the way, IRMA stands for Income-Related Monthly Adjustment Amounts. Required maximum distributions can also force income at times when it may not be needed. Flexibility is one of the greatest benefits of tax diversification in retirement. Having access to multiple tax buckets allows retirees to manage income intentionally from year to year, adjusting withdrawals based on tax brackets, market conditions, and personal needs. This flexibility can help smooth income, reduce lifetime taxes, and minimize surprises. You can shift withdrawals to stay within tax brackets and respond to market swings or one-time expenses. Okay, how do you build tax diversification? It's built over time using strategic contributions, thoughtful use of Roth options, and coordinated withdrawal planning. Decisions made during working years, early retirement, and RMD phase all influence future tax outcomes. This is a planning process rather than a single decision. Regular reviews and adjustments matter as tax laws, income needs, and personal circumstances change. Okay. Key takeaways: not all dollars are equal. A dollar in a Roth account, if you're following the rules, is worth more than a dollar in a traditional IRA or 401k, because when those dollars come out, they have to be taxed. Also, Roth IRAs do not have a required minimum distribution. Uncle Sam got paid up front, so he doesn't really care when you take them. Flexibility has real value. Tax diversification improves control over taxes, income timing, and sustainability. But you've got to plan proactively. Better outcomes come from planning rather than relying on guesswork. And you should ask better questions of your planner. So if you're within 5 to 10 years of retirement or already retired, you're wondering how to take income efficiently, if you're concerned about taxes, Medicare surcharges, or legacy, a retirement tax review can be worthwhile, and I can help with that. So once you graduate, be it from welding school, engineering school, or law school, you're going to need a different plan for each of these stages that's tailored to your individual situation. During your working years, am I saving enough, and is it in the right place? Not just the right investments, but the right tax or taxable account or Roth. Glide path to retirement. your last 10 years prior to retirement. That's my arbitrary label. Will the U.S. retirement be shipshape on the appointed day? And retirement. How do I avoid running out of money before I run out of life? And finally, your legacy. Does what I worked hard for get to where I wanted to after I'm done with retirement? I can be reached at herwirefinancial.com. I do in-person, phone, and Zoom appointments. I am licensed and registered across several states and can easily add states if there's a need. You want to schedule an appointment, you can click on the Schedule an Appointment button in the upper right-hand corner of my website. If you want to see more videos like this, go to my website and click on the YouTube channel button. It's that red one between LinkedIn and Facebook. If your friends want more information, they can follow me on Facebook, LinkedIn, Twitter, or can subscribe to my YouTube channel. Those who prefer the good old-fashioned telephone, 518-631-2569. Do not text that because we'll both be sad because I will not get it. There's a separate texting number. Opinions voiced in this material are for general information only, not intended to provide advice or specific recommendations for any individual. All performance referenced is historical, no guarantee of future results. All indices are unmanaged and may not be invested in directly. All data is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. None of this is to be construed as tax or legal advice. Consult your advisor prior to taking any action. This information is intended to be educational and not tailored to the investment needs of any specific investor. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Okay, everybody, have a great week. I'll see you next time.